The 4-decade mean, according to JPMorgan Chase, not some old bald gold bug, JPMorgan Chase, is that the market share of precious metals and precious metals securities over the last 40 years in the U.S. market has been 2%. Gold doesn't need to whip the U.S. dollar. Gold doesn't need to break the Treasury market. All it has to do is revert to mean. If it reverts to mean, the market share in the U.S. market grows fourfold. Now, can you imagine what a fourfold increase in demand for gold and gold stocks in a market that controls 23% of the savings and investment assets in the world would do to the gold price?
According to JPMorgan Chase, the market share of precious metals and related securities in the U.S. has been around 2% over the past 40 years. Gold doesn't need to outperform the U.S. dollar or disrupt the Treasury market. It needs to return to its historical average. If this happens, the market share of gold could quadruple, potentially driving a significant surge in gold demand and prices, given that the U.S. controls 23% of global savings and investment assets. JP Morgan forecasts that gold will average $2,500 per ounce in the fourth quarter of 2024, potentially reaching $2,600 by the end of 2025. The former president and CEO of Sprott U.S. Holdings Incorporated, RickRule, explains gold has risen from $253 per ounce in 2000 to around $2,600 today, a sevenfold increase with an average annual return of 8.2% over 24 years. This steady growth demonstrates its effectiveness in preserving purchasing power. Despite this track record, precious metals account for less than 0.5% of U.S. savings and investment assets, showing minimal market penetration. RickRule also talks about how the U.S. and Canadian oil and gas industries could benefit if former President Trump removes oil and gas transmission regulations and builds natural gas liquefaction facilities on the U.S. East Coast. This would address the current surplus of gas priced at $2 per million BTU domestically, compared to $10 in international markets like Europe and Asia. While Canada's Prime Minister Trudeau currently opposes expanding gas infrastructure, a policy shift could enable Western Canadian gas to reach global markets via U.S. and Canadian routes, boosting the industry's potential. Join us for an in-depth analysis of the video, and be sure to subscribe and hit the bell icon to stay up to date with our latest content.
In the year 2000, it was at $253 an ounce. Now it's at $2,600. In other words, it's up, what, sevenfold?
Yeah.
Gold has increased by almost 8.5% compounded for 24 years. It's done exactly what it was supposed to do. It's protected by purchasing power for 24 years. So when you're asking me when gold going to move, 24 years ago. What I really like about it from an investment perspective is that it has this wonderful track record. Market share of precious metals and precious metal securities in the U.S. market, the market that I know the best, is less than 0.5%. Less than 0.5% of savings and investment assets in the United States are precious metals related. The surprising beneficiaries will be both the U.S. and the Canadian oil and gas industry.
Right.
I think that Trump will dismantle the de facto regulation around the transmission of oil and gas in the United States and the construction on the East Coast of natural gas liquefaction facilities. That's important for Americans because right now we're producing a lot of gas as a byproduct of oil, more gas than we can store or sell. That same gas, which is priced at Henry Hub at $2 US or at AECO for $1.50 Canadian, that same gas sells for 10 US dollars, 13 Canadian dollars as liquefied natural gas in Rotterdam, in Shanghai, and Tokyo. The ability to gather that gas, process that gas, store that gas, ship that gas, liquefy it, and deliquefy it is what changes that $2 a million BTU into $9 or $10 a million BTU. It's important that Canadians understand that although your Prime Minister doesn't see a business case for Canadian natural gas in Europe and likely will not allow liquefaction or transmission infrastructure in Canada, it's very likely that President Trump will.
Yeah.
And the ability of producers in the Western Canadian Sedimentary Basin to ship liquefied natural gas through BC, that's already underway to Asia, but also ship Canadian natural gas through the U.S. to ports on the Atlantic coast of the U.S., even though it would be more efficient to load that gas in Quebec. That'll be important for Canadians. If the electorate in Canada changed their mind and allowed Mr. Trudeau to pursue other employment opportunities, that benefit might come.
The junior mining sector is plagued by poor financial performance, with most companies losing money annually. RickRule highlights that if all 2,500-plus junior miners merged, they would lose $1 to $2 billion annually. Investing broadly in this sector over a decade could lead to financial ruin, though a small subset, around 5%, delivers strong returns. Issues like excessive executive rewards and poor capital allocation further weaken trust. A study of TSX venture companies revealed that over 60% of raised capital goes to administrative costs, leaving less than 40% for actual mining work. The speaker, RickRule, owns gold not for short-term gains, but as a safeguard against potential economic instability. They believe gold serves as a reliable store of value during times of uncertainty about fiat currencies, especially given the U.S. debt levels. They aren't focused on gold reaching $3,000, but are concerned it could rise significantly, even to $10,000, due to fundamental economic pressures. Now, let's dive into the interview.
The problem is in the junior sector, there's not very many high-quality issuers. It's mostly the lame, the halt, and the blind. We've talked about this on Kitco before. If you merge the whole public company universe in mining to Junior Explorco, one company, worldwide, merge these 2,500 or whatever they are companies into one, that company in a good year would lose $2 billion. In a bad year, it'd lose $10 billion. So you tell me, how much do you pay to lose $2 billion a year? Should you pay 8 times losses? In a bull market, should you pay 15 times losses? The truth is that if you invest in the sector overall, I'm talking about the juniors, over a decade you will go broke. That's what will happen. That disguises the fact that there's a subset of issuers, perhaps 5% of the total population, that generates so much performance that it adds legitimacy and sometimes luster to a sector that loses $2 billion every year. You pointed out to me, and we'll make the company nameless, a junior company recently was successful raising $2 billion and as a consequence awarded themselves $10 or $15 million worth of restricted stock units for doing nothing. Remember that the private sector is always more efficient than the government sector, even when it comes to printing phony paper. A different statistic is we had a young intern many years ago, that's financial speak for slave, and we had this young man pull 25 TSXV companies at random and look at their balance sheets and income statements. And he reported back to me, we weren't looking for this, he just found it, that the median TSXV company in a 25 company selection spent over 60% of capital raised in general and administrative expense. Less than 40% of the capital raised went in the ground. Now, how's that going to work? I don't own gold because I think it might go from 2,600 to 3,000. That's why I don't own it for that reason. I own it because I'm afraid it's going to go to 10,000. I own it because gold historically has been a store of value during periods of time when people were concerned about the maintenance of their purchasing power in fiat instruments. And when I consider the debt problem that you and I just discussed, relative to the national income, I don't believe there's any way in the world that the US dollar can maintain its purchasing power. That's why I own gold. Do I know or care if it's going to $3,000? Not the faintest concern, not the faintest interest, neither. I own gold because I don't understand arithmetically how it can't go in nominal terms to the next.
Gold remains a critical asset for preserving purchasing power amid economic uncertainty, while the broader precious metals market shows significant growth potential if it returns to historical norms. Meanwhile, the junior mining sector faces poor financial performance and inefficient capital allocation. On the energy front, deregulation in the U.S. could create opportunities for American and Canadian oil and gas industries to capitalize on global demand for liquefied natural gas. These dynamics highlight both risks and opportunities across commodities and energy markets. How might a shift in regulatory policies impact the long-term viability of the North American energy sector? What strategies could junior mining companies implement to improve their financial performance and regain investor trust? That wraps up today's discussion. Let us know your thoughts in the comments below. If you enjoyed the video, give it a thumbs up and subscribe for more updates. Thanks for being part of the journey.